Hi there. So in this short video, I'm going to talk about central banks and central banks monetary policy. Look, it's going to be kept quite short because we've already done some stuff today, and I'm going to just cover an outline of monetary policy in central banks. I'm not going to go into a huge amount of detail. If you want to fill in the details or you want to know more specifically, then go to the readings that I've identified in week 6. And if you want more than that, then come and talk to me and I will happily help you out. Okay, so monetary policy is a central bank tool in order to be able to increase or decrease interest rates in order to be able to control inflation. And I think this is really important here, is because the view would be that interest rates or the price of the cost of money is an effective way of controlling what goes on in the economy. Is that by increasing interest rates is that you can cool the economy down and therefore lower inflation, and then the opposite happens if you were to lower interest rates. You lower interest rates, it stimulates the economy, because by lowering the interest rates is that you reduce the cost of money, which means that the demand of money goes up and people will take money and they'll borrow money and spend more money. You've got to say, however, that empirically this doesn't seem to be the case at all. Is that the evidence for this, which is a sort of a maxim or an axiom almost of economics and banking theory, is that if you were to look at the empirical evidence over the years, you'd have to suggest that really is that interest rates follow GDP rather than they're causing the GDP growths. And as a consequence of that is that we really ought to think about the effectiveness of that as a policy. Nevertheless, central banks adopt, well, not all central banks, but the majority of central banks, particularly the larger ones, have adopted a target inflation rate of 2%, and that's believed to be the ideal inflationary rate, which corresponds to the economy operating in equilibrium. Okay, central banks are independent. They're supposed to have no political intervention, and therefore they set the desired interest rates in order to be able to meet their outcomes. Now, again, it's important to note here is that the outcomes of central banks is inflation rates. That's what they're trying to target, because the target inflation rate corresponds to equilibrium, where the economy is working efficiently and therefore will be growing at its optimum level as well. Some central banks are mandated to achieve employment rates, particularly the Federal Reserve of the US, which targets a 6.5% unemployment rate, which is again interesting in and of itself, because it does make the assumption, therefore, that a certain percentage of the American population are unemployable. Inflation and unemployment rates are believed to be in a reverse relationship. So low unemployment causes inflation and vice versa. Now, this again is interesting, because what is effectively happening here is that the central bank will be trading off inflation rates for unemployment rates. So whilst if the economy is operating at equilibrium at a 2% inflation rate, is that there is therefore a corresponding 6.5% unemployment rate. So the central bank will trade people's jobs for stability of the economy. Importantly, central banks are lenders of last resort. And this really basically means that during any crisis is that they'll provide the liquidity to the banks in order to prevent a collapse of the financial system and therefore the economy drifting into economic depression. This occurred in the global financial crisis, in that commercial banks were under a huge amount of stress. There had been in the UK the collapse of Northern Rock, which is a small bank that we talked about before. In America, there had been the collapse of Lehman Brothers, and it was abundantly clear that a number of other actors in the banking system were under the same amount of pressure. There is an apocryphal story of Alistair Darling, the chairman of the, Chancellor of the Exchequer, calling the chairman of the Royal Bank of Scotland and asking him how long would it be before they were technically insolvent, and he responded back with the answer of about 5.5 hours. So on that basis is that there was a real need for the central bank to provide additional liquidity in the form of loans, basically. And so they did that. That's the job of the bank, of the central bank as a lender of last resort. I think it's interesting, because we really ought to mention this here, is that if the central bank is the lender of the last resort, is that we have an issue there, which is referred to as moral hazard. Is that if, let's assume that we all work within a bank and we are creating mortgage-backed securities and collateralized debt obligations with insurances, but we have a sneaking suspicion that they're overpriced and that really we shouldn't be selling the mortgages that we are selling the mortgages, or packaging the mortgages and securitizing the mortgages as we are doing, we should stop because of the inherent risk to the system. However, why do that when we can carry on knowing that should the bank, our bank, the bank that we work for, fall into stress, is that the central bank will effectively bail us all out? That's what's known as moral hazard, and it doesn't work for consumers, does it? Is that if the economy slows down, you lose your job and therefore you can't pay your mortgage, nobody bails you out. But in corporate terms, the central bank steps in and helps the commercial banks. And that's gone further during COVID, in that central banks have stepped in order to be able to provide financing for firms that have struggled or are struggling as a consequence of COVID. Anyway, back to the script. After the 2007 crisis, all the major central banks, the Fed in the US, the European Central Bank, the Bank of England, and also Bank of Japan, first acted as lenders of last resort, i.e. it made loans to their banks, and then secondly, it provided monetary stimulus, open market operations. There's a very good section on open market operations on Investopedia, but basically what this means is that they are creating additional liquidity to the market by buying some of the assets of commercial banks, or lending them money, and the collateral would be the assets that they've got. Monetary policy involved large-scale asset purchases, which is known as quantitative easing, buying both government bonds and private company bonds. And that's probably a little simplistic, actually, and there's a separate video on quantitative easing which will be posted later. What we need to understand here is this idea about the transmission mechanism, is that how is monetary policy supposed to assist the economy at a time of stress? Well, when the bank signals that it's going to make, this is the central bank, by the way, when the central bank signals that it's going to make considerable amounts of asset purchases, there are three effects. There's three channels, if you like, of the transmission mechanism. The first one, the blue one, is that the Bank of England buys a load of assets, which basically signals an expectations to the market that things are okay. The Bank of England will step in. Expectations rise, and as a consequence of that, spending and income goes up and inflation stays at 2% because that's its optimum level. The next one is that the Bank of England buys a load of assets. Well, the asset prices go up in value. So if you're holding those assets, then you've gained additional wealth, but also the cost of borrowing goes down because of the market operations, which increases spending and income. Wealth increases spending and income too. Inflation stays at 2% because that's the equilibrium level. And then the third one is that the Bank of England makes asset purchases, which increases the money supply, which increases monetary bank lending, which increases spending and income, and inflation stays at 2%. And it's that latter one. Well, really, I think that we could probably question the efficacy of all of those as part of the transmission mechanism and the likely effect it's going to have on the economy. But broadly speaking, is that the monetary policy of the central banks has a three-way impact upon the economy, which broadly speaking increases spending and income, which is GDP at the inflationary rate of 2%. Now, I think I just wanted to draw your attention to what's going on at the moment. And with COVID-19 is that the central bank policies, which have been broadly speaking known as unconventional monetary policies, the buying of this quantitative easing, buying of large-scale assets and increasing liquidity into the markets, took a significant historical turn. You can see from the graph that I've got here that's open in front of you, is that from a historical period leading up to COVID, is that there have been this sort of like fluctuation in the size of the balance sheets, and that's what this is broadly showing you. It's the size of the balance sheets, which is an indication of the amount of assets that the central banks have purchased over time. Now, prior to COVID, is that certain central banks, like the Fed, which is the blue bit here, had actually been trying to unwind its positions. What that basically means is, instead of quantitative easing, you've got quantitative tightening, is that they are offloading things and selling back into the market some of the assets that they're holding. But you've got a general dip in purchases, and then COVID kicks in, and then you can see that there is this dramatic rise in purchases again. Far, far significant than anything that we saw as a consequence of the global financial crisis. Now, this is part of the conjuncture, is it not? Because of the fact that this co-joining at this juncture in time and space is totally unique. We've seen QE before, from 2008. Well, actually, that's not strictly true. It's probably 2011 onwards. And then it started to taper down, but nothing like we've seen before. So the conjuncture again is unique. We are experiencing something that we've not seen before. So when people say, well, what's likely to happen, or are making predictions about the future, we are making predictions on things that we've never seen. Now, you can't, as I've said to you before, is that you can calculate the probability of things that you've seen before, but you can't calculate the probability of something that you haven't seen before. It's uncertain, and therefore, in strictest terms, we really don't know what the impact of all of this additional expenditure from central banks is likely to cause or create. But one of the things that perhaps we ought to draw our attention to is that interest rates have gone down to a historical low prior to COVID, with no real sense of substantial growth within economies, particularly the advanced economies. In fact, most economies were slowing down, and a huge increase in additional liquidity, money supply to economies, with no commensurate growth in inflation rates. So this really ought to signal the death knell of the quantity theory of money. However, I dare say that, and as I'm recording this, is that Biden has just won in America. And let's give it 6 months before the Republicans start to ask questions about the size of the public debt and say that this is going to be bankrupt in America. They won't be able to afford their debts, and inflation, hyperinflation is just around the corner. Mark my words on that one. Okay, that's the end of this little short video. Speak soon. Bye-bye.